Good morning. I'm tracking the Atlanta commercial real estate market on a pivotal day for the Southeast's economic engine. The city sits at an inflection point, mortgage rates holding steady above 6%, unemployment ticking slightly higher, and a Federal Reserve that remains cautious on inflation. Today, we're unpacking what this means for investors, landlords, and developers across the metro. Let's begin. Atlanta's commercial property landscape reflects broader macroeconomic pressures that are reshaping tenant demand and capital deployment across the Southeast. The city has long functioned as a bellwether for Sunbelt migration and logistics growth, but recent monetary conditions are introducing friction into deal flow and lease negotiations. With the federal funds rate estimated at 5.33%, the cost of capital remains elevated for both property acquisitions and development financing. Mortgage rates for commercial properties are tracking at 6.66%, a figure that compresses returns on stabilized assets and forces sponsors to recalibrate underwriting assumptions. Let's examine the employment and construction data that define Atlanta's near-term trajectory. Unemployment in the metro currently stands at 3.7%. That figure warrants careful analysis. While 3.7 remains below the historical average, we're seeing subtle signs of labor market softening. For office landlords and flex space operators, this is significant. Tenant occupancy stability depends on employment momentum. A flat or declining unemployment trend could translate into sublease supply and rental concessions before we see material mark-to-market pressure. Three structural trends are reshaping Atlanta's commercial real estate allocation right now, and investors must account for each. First, yield compression in core assets is driving institutional capital toward value-add and opportunistic strategies. With 30-year mortgages at 6.66% and cap rates on trophy office and retail in the 4 to 5% range, the risk-adjusted return profile of stabilized assets has deteriorated. Sponsors are responding by underwriting renovations, repositionings, and mixed-use conversions, particularly in underhoused submarkets like Midtown, the Beltline Corridor, and emerging industrial zones north of the airport. Atlanta's commercial real estate market is neither euphoric nor distressed. It is disciplined and selective. That discipline is a feature, not a bug. For institutional investors, family offices, and operational real estate companies, this environment rewards diligence, selectivity, and capital patience. The macroeconomic data we've reviewed, elevated rates, moderate inflation, and stable employment, will not resolve overnight. Your investment decisions should reflect that reality. RipplEffekt provides institutional-grade market intelligence, asset-level analysis, and deal sourcing across Atlanta's most dynamic submarkets. Visit us at RipplEffekt.com for the full intelligence brief.